did you know that property prices in the UK could drop by as much as 30% by 2026? It sounds unbelievable, right? But the signs are already here, and many experts are predicting that a major crash is inevitable. For years, we've seen the UK housing market skyrocket to levels that many simply can't afford. But what if I told you that the bubble is about to burst? The shocking truth is that we might be staring down the barrel of one of the biggest property crashes in decades, and it's closer than you think. So what's causing this? Rising interest rates, an aging population, and the cost of living crisis? These are just a few of the reasons why the housing market is teetering on the edge of disaster. What does that mean for you? Whether you're a homeowner, a potential buyer, or an investor, the next few years could change everything. In this video, we're diving deep into 10 shocking reasons why the UK housing market is heading for a dramatic crash by 2026. You'll be stunned by how quickly things could turn, and you'll want to stick around until the end to learn how these developments could impact your finances, your home, and your future. Do you really know what's happening with the housing market? Or are you just waiting for the next big shock? Keep watching to find out what could happen next and why you might want to rethink any plans to buy or sell a property soon. Number 1. Rising interest rates. One of the most significant factors contributing to the anticipated crash of the UK housing market in 2026 is the rising interest rates. If you've been keeping an eye on the news or your personal finances lately, you've probably noticed that interest rates are steadily climbing. But what does this really mean for the housing market, and why should you care? Interest rates are the cost of borrowing money, and they directly impact how much someone will pay on their mortgage. When interest rates go up, monthly mortgage payments become more expensive. For example, a small increase in interest rates can turn a relatively affordable monthly mortgage payment into a financial burden for many families. This is particularly concerning when we consider that the UK housing market has been fueled by cheap borrowing over the last decade. With low interest rates, people could afford larger homes, and property prices soared as demand outstripped supply. However, as interest rates rise, the cost of borrowing increases, which means fewer people can afford to buy homes at current prices. Research shows that as mortgage rates rise, the number of home buyers decreases. When demand drops but supply remains relatively high, it leads to an imbalance that can trigger a market correction. The Bank of England has already started tightening policies to control inflation, and many experts believe that we'll continue to see interest rates rise over the next few years. This will lead to more expensive mortgages, creating pressure on current homeowners who may struggle to sell or refinance. For first-time buyers, the situation becomes even more challenging. The combination of high property prices and higher interest rates could make home ownership seem out of reach, leading to a decrease in demand. Ultimately, as more people become priced out, the market will likely see a slowdown, and eventually, a potential price correction that could trigger the crash predicted for 2026. Number 2. The cost of living crisis. Another major factor contributing to the potential crash of the UK housing market in 2026 is the ongoing cost of living crisis. Over the past few years, the UK has seen a sharp increase in the cost of everyday essentials, energy bills, food prices, transportation costs, and more. This financial strain is leaving many households with less disposable income, which has a direct impact on the housing market. When people struggle to cover the rising costs of basic needs, purchasing a home becomes a lower priority. Home buyers are less likely to enter the market when their income is stretched thin, and many homeowners are holding off on selling because they fear they won't be able to afford the higher costs of moving. This decreased consumer confidence could lead to a dip in overall demand for homes, contributing to an oversupply in the market. At the same time, renters are also feeling the pressure. Many are being forced to allocate a larger portion of their income toward rent and utility costs, leaving them with little room to save for a down payment on a property. This creates a barrier to entry for first-time buyers, further stagnating the housing market. As demand slows, home prices may stabilise or even fall, particularly in areas where housing was once considered overpriced or unaffordable. Studies show that when individuals are faced with financial instability, they tend to pull back from making major financial decisions, like buying a home. This creates an environment where the housing market struggles to maintain momentum, with fewer buyers willing to pay top dollar for properties. The cost of living crisis, combined with rising inflation and wages that aren't keeping pace with rising costs, could significantly reduce the purchasing power of the average Briton. As this trend continues, it's likely that the housing market will see a slowdown or even a sharp decline in prices, setting the stage for a potential crash by 2026. Number 3. Supply chain disruptions. One of the lesser discussed but crucial factors contributing to the potential collapse of the UK housing market in 2026 is the ongoing supply chain disruptions. These disruptions, which have affected everything from raw materials to labour forces, are putting a major strain on the construction and housing industry, making it harder to meet the demand for new homes. The construction sector relies heavily on materials like timber, steel, and bricks, many of which are imported from abroad. However, global supply chain issues, exacerbated by the COVID-19 pandemic, Brexit, and other geopolitical factors, have led to severe shortages and skyrocketing prices for these materials. In fact, the cost of building materials has risen dramatically in recent years, making new construction projects far more expensive. Builders are now forced to either delay projects or pass on the increased costs to buyers, which makes new homes even less affordable for the average person. Moreover, the shortage of skilled labour is another significant issue. Many construction companies have struggled to hire the workers they need due to labour shortages, further delaying projects and limiting the number of homes being built. Brexit, in particular, has exacerbated this problem, as it led to a reduction in the availability of migrant workers who were previously a crucial part of the UK's construction workforce. As a result, while demand for housing continues to rise, the actual supply of homes is not keeping pace. This creates a severe imbalance in the market, where potential buyers are forced to compete for a limited number of properties, driving up prices. However, if these disruptions persist and housing supply remains constrained, we could eventually see a bubble form, only to burst once the inflated prices are no longer sustainable. Ultimately, these supply chain challenges have long-term effects, potentially stalling the housing market and leading to a significant correction by 2026. As construction costs continue to rise and home building slows, affordability issues will likely worsen, making the housing market ripe for a crash. Number 4. Government policy and regulation changes. Government policies and regulatory changes are always key factors in shaping the housing market, and in 2026, they could play a significant role in triggering a potential crash. The UK government has already signalled its intention to introduce new policies that could drastically alter the housing landscape. These changes, while aimed at addressing affordability and housing shortages, could inadvertently create more instability in the market. One of the key policy shifts being discussed is increased taxation on property ownership. Over the past few years, the government has introduced higher taxes for landlords and second homeowners, aiming to make housing more affordable for first-time buyers. However, these tax hikes have made property investment less attractive, leading to a potential slowdown in demand. If these taxes increase further, it could encourage property investors to sell off their portfolios, flooding the market with homes and driving prices down. Additionally, the government has been exploring rent control measures to help curb the rising cost of renting. While rent controls may sound like a good solution for tenants, they can have negative consequences for the housing market. By limiting rental income, landlords may be discouraged from maintaining or investing in properties, further reducing the supply of homes for rent and pushing prices up. It also creates an environment where fewer people are willing to invest in housing, leading to a stagnation in property values. Finally, the introduction of more stringent building regulations and policies aimed at making homes more energy efficient could add additional costs to new housing developments. While these changes may ultimately improve the quality of homes in the long run, in the short term, they could increase construction costs, slowing the rate at which new homes are built and putting additional pressure on housing supply. In summary, changes in government policy and regulation, whether through higher taxes or more stringent rules, could have far-reaching effects that destabilize the housing market, leading to the crash anticipated in 2026. Number 5. Excessive debt in the economy. Excessive debt, both at the personal and national level, is another key factor that could trigger a housing market crash in 2026. Over the past decade, the UK has seen a significant rise in household debt, driven largely by mortgages, personal loans, and credit card balances. This growing debt burden has made many households increasingly vulnerable to economic shocks, particularly in an environment of rising interest rates and inflation. At the individual level, many homeowners and potential buyers are heavily reliant on credit to finance their homes and lifestyles. With rising interest rates, the cost of servicing existing debt is becoming more expensive. Higher monthly payments on mortgages and personal loans mean that fewer people have the financial flexibility to make large investments, like purchasing a home. This reduces demand for housing and puts pressure on property prices, which could lead to a market correction. Moreover, the UK's overall national debt has also increased substantially in recent years, further complicating the situation. As government debt rises, there is a higher risk of austerity measures or tax hikes in the future, which could further strain household budgets. Economic instability, driven by growing debt levels, could make both buyers and sellers more cautious, further slowing down the housing market. Excessive debt also leads to financial fragility, where small economic shocks can have disproportionately large effects on the housing market. A sudden economic downturn, a spike in interest rates, or a loss of confidence in the economy could cause a domino effect, leading to a wave of defaults and foreclosures. This would flood the market with properties, driving prices down and creating a buyer's market in a situation where fewer buyers can afford to enter. Number 6. Aging population and changing demographics. The UK's aging population and shifting demographics could have a profound impact on the housing market, contributing to a potential crash in 2026. As the baby boomer generation ages and more people reach retirement age, the demand for certain types of housing is likely to change, creating long-term challenges for the housing market. Aging homeowners are increasingly looking to downsize or move into more suitable living arrangements, such as retirement communities or smaller homes. As a result, we could see a significant number of larger family homes hit the market, especially in suburban areas. While this may seem like an opportunity for first-time buyers, it could create a glut of properties that aren't aligned with the current demand for housing. First-time buyers today tend to prefer more affordable, smaller homes or apartments, not large family estates that are often harder to maintain and more expensive to heat and run. At the same time, the shift in household composition is also affecting the demand for housing. More people are opting for smaller households, with a rise in single-person homes and childless couples. This means that larger homes, which were once in high demand, may no longer be as sought after. Consequently, the market could see a decrease in demand for larger homes, leading to a fall in prices for this type of property. The aging population also affects the rental market, as older renters may be more likely to move into specialised accommodation tailored to their needs. As they vacate rental properties, there may be fewer younger renters willing to pay high prices for properties in the same areas, leading to an oversupply of rental properties in some regions. In summary, demographic shifts, including the aging population and changing household structures, will create imbalances in housing demand, potentially driving prices down and contributing to the housing market correction expected in 2026. Number 7. Unpredictable global events and economic downturns. Unpredictable global events and economic downturns have always had the potential to disrupt the housing market, and as we look toward 2026, these factors remain a significant risk. The UK housing market is not immune to global instability, whether it's caused by geopolitical conflicts, economic recessions, or unforeseen crises like pandemics. Such events can lead to economic uncertainty, which in turn impacts both consumer behaviour and investment decisions in the housing sector. For instance, events like the COVID-19 pandemic demonstrated how quickly global crises can shift economic conditions. The pandemic led to a temporary halt in the housing market, with many buyers and sellers pulling back due to uncertainty about the economy and personal finances. Similarly, other unforeseen global events, like the war in Ukraine or rising tensions in major economies, could cause financial markets to fluctuate, prompting caution among home buyers and investors. This global uncertainty leads to lower consumer confidence, which could cause people to hold off on purchasing property or making large financial commitments. In addition, an economic downturn or recession, whether driven by global trade disruptions, rising inflation, or stock market crashes, could have a direct impact on the housing market. When the economy contracts, people lose jobs, experience wage stagnation, or face financial strain, making them less likely to invest in real estate. Home buyers may be reluctant to take on large mortgage commitments in times of economic instability, while sellers may be forced to lower their prices to attract buyers who are now more cautious. Lastly, tightening credit conditions in response to global economic conditions could further restrict access to home loans, reducing the pool of potential buyers. With fewer people able to purchase homes, the market could face a decline in demand, leading to a potential housing crash by 2026. Simply put, the unpredictable nature of global events remains one of the most significant risks to housing market stability. Number 8. The rise of remote work and changing lifestyles. The rise of remote work and the shift in lifestyle preferences have profoundly altered the housing market, and these changes are expected to continue influencing the UK housing landscape through 2026. As more people have embraced remote work, many are re-evaluating where they live and what they need from their homes. This evolving work environment is leading to shifting demand patterns that could ultimately contribute to a housing market downturn. Before the pandemic, the majority of people were tied to commuting patterns, with the demand for housing concentrated around city centres, where access to jobs, public transport, and amenities was crucial. However, the remote work revolution has made it possible for people to work from almost anywhere. As a result, many individuals and families are moving away from expensive urban areas to more affordable towns, suburbs, or even rural locations. This shift is pushing down demand for properties in city centres and leading to an oversupply of homes in these areas. For example, London, which once saw constant price growth due to its status as a global financial hub, is now experiencing a slowdown. Many young professionals who would typically flock to the city for career opportunities are opting for more spacious and affordable homes outside the capital, especially as remote working allows them to keep their jobs without the long commute. This could lead to a devaluation of properties in city centres as demand decreases, while suburban or countryside homes may see price increases. In addition to location flexibility, people are increasingly prioritising different features in their homes. Larger spaces for home offices, outdoor areas, and more privacy are becoming key priorities for many buyers. As a result, properties in urban areas that don't meet these new preferences may struggle to maintain their value, leading to a shift in housing market dynamics that could cause prices to fall, particularly in cities. Number 9. The overvaluation of properties. One of the most concerning factors contributing to the potential crash of the UK housing market in 2026 is the overvaluation of properties. Over the past decade, property prices have surged to unsustainable levels in many parts of the country, particularly in major cities and popular commuter zones. This overvaluation has created a housing bubble where prices are inflated far beyond what the average buyer can realistically afford, often driven by speculation and investment rather than genuine demand. The issue of property overvaluation becomes especially evident when comparing house prices to average wages. In many areas, the price of an average home has grown at a rate far outpacing wage growth, leaving a significant affordability gap. For example, while salaries have stagnated or grown slowly, property prices have continued to climb, leading to a situation where it takes an increasingly larger portion of income just to cover the cost of buying a home. This means that many properties are priced out of reach for the average buyer, but they remain artificially elevated due to speculative investment rather than organic demand from individuals looking for a place to live. When the market becomes overvalued, it is often just a matter of time before a correction occurs. Investors who bought properties with the expectation of future price growth may decide to sell when they see signs of stagnation or decline, flooding the market with properties and driving prices down. This could create a domino effect where more homeowners try to sell off their properties before the market drops further, leading to a sharp decline in house prices. In addition, rising interest rates and an increasingly cautious public could make it difficult for buyers to justify the high prices, leading to a lack of demand. Number 10. Investment-driven market, not demand-driven. A critical factor that could drive the UK housing market toward a crash in 2026 is the increasing reliance on the investment-driven market, rather than one based on genuine demand for homes. Over the past few years, the housing market has seen a significant shift, with properties increasingly being purchased not just as homes, but as investment assets. This trend has distorted the natural supply and demand balance, making housing prices artificially inflated and vulnerable to a market correction. In an investment-driven market, wealthy investors, large corporations, and foreign buyers have increasingly purchased properties as a means of generating profit through rising property values and rental income, rather than buying homes to live in. This has led to a situation where property prices are driven by speculation and future profit expectations, rather than the actual needs of local homebuyers. As a result, housing prices are disconnected from the incomes and financial realities of the average person, leading to overvaluation and a lack of affordability for first-time buyers. This trend is particularly pronounced in prime areas of major cities like London, where luxury apartments and high-end homes are often bought by investors, not by individuals seeking a place to live. As demand from regular home buyers falters, these investment properties can flood the market if investors choose to liquidate their holdings. Market instability occurs when the demand from speculative buyers evaporates, leaving a glut of properties with few genuine buyers to sustain prices. As global economic conditions become more uncertain, and if property investment returns begin to slow down or stagnate, investors may start to sell off their properties, triggering a sharp decline in prices. This shift could signal the beginning of a housing market correction, potentially leading to the crash that many experts predict by 2026. The housing market's over-reliance on investments rather than actual demand could ultimately cause it to collapse when speculative interest wanes. So there you have it. 10 shocking reasons why the UK housing market is on the brink of a massive crash by 2026. From rising interest rates to government policies and even the global economic situation, it's clear that the foundation of the housing market is shaky. Whether you're a first-time buyer, a homeowner, or an investor, these insights could change the way you view the property market. The truth is, no one can predict the future, but the signs are clear, and the potential risks are too great to ignore. If you're thinking about buying or selling in the next few years, Now is the time to reconsider your options. The housing market could shift dramatically, and understanding the risks is key to making informed decisions. We've put a lot of effort into bringing you this information, so if you found it valuable, don't forget to like, subscribe, and click the notification bell. Your support helps us create more in-depth content like this. Got thoughts? Drop a comment below and let us know what you think will happen to the UK housing market in the coming years. Your insights matter to us.